Every month, millions of Indians are putting money into mutual funds. Not 500 rupees once, not 5,000 rupees occasionally, but SIP after SIP, month after month. And here's the interesting question. Why? Even when the stock market falls, even when investors see red numbers in their portfolios, even when people say the market is too expensive, SIP money keeps flowing. So what exactly is driving this massive faith in mutual funds? Is it returns? Is it convenience? Is it social media? Or has investing itself become a habit for India's growing middle class? Today, let's understand the real reasons. The first reason is simple. SIP has become a habit. For many investors, investing 2,000 rupees, 5,000 rupees, or 10,000 rupees every month has become just another monthly expense. Like electricity bills, like school fees, like rent, the money gets automatically deducted from the bank account. And that's powerful, because successful investing isn't always about making the perfect decision. Sometimes, it's about making investing automatic. When you invest manually, emotions can interfere. You may say, "I'll invest next month. The market is too high. I'll wait for a correction." But with an SIP, the investment continues according to the schedule. That creates discipline. And over a long period, discipline can become more important than trying to predict the market. The second reason is something every long-term investor eventually discovers: compounding. Imagine you invest 10,000 rupees every month. That's 1.2 lakh in 1 year. Now imagine continuing that for 10, 15, or 20 years. Your money doesn't just grow because you're adding new money. Over time, your accumulated returns can themselves generate returns. That's the magic of compounding. But here's the important point. Compounding doesn't work like magic overnight. It needs time. That's why younger investors are increasingly starting SIPs early. They may not have a huge amount of money today, but they have something even more valuable: time. And time can turn relatively small monthly investments into meaningful wealth. Of course, mutual funds don't offer guaranteed returns. Markets rise and fall, but the long-term wealth-building potential is one reason SIP investing remains popular. The third reason is technology. Investing in mutual funds is no longer complicated. A few decades ago, investing could feel intimidating. Forms, paperwork, physical documents. Today, you can start an SIP from your smartphone. You can check your portfolio while sitting at home. You can increase your SIP, pause it, change the amount, track your investments, and compare different funds. This convenience has dramatically lowered the barrier to investing. A young employee in a small Indian town can start investing with a relatively small amount. You don't necessarily need to be wealthy to begin, and that has helped bring investing to millions of ordinary households. There's another major change happening in India. The middle class is becoming more conscious about long-term financial goals: retirement, children's education, buying a house, financial independence, emergency funds, and simply building wealth. Earlier, many families primarily depended on fixed deposits, gold, property, and traditional savings. Those options still have their place, but today's investors are increasingly looking for investments that can potentially participate in economic growth. And mutual funds provide access to different asset classes through professionally managed portfolios. That's one reason SIPs have become such a powerful financial habit. People aren't necessarily investing because they want to become rich tomorrow. They're investing because they want their future self to have more choices. Now let's talk about something every investor fears: market crashes. When markets fall sharply, many investors panic. But SIP investors have one psychological advantage. They continue investing through different market conditions. When prices are high, their monthly investment buys fewer units. When prices fall, the same amount can buy more units. Over time, this creates the mechanism commonly associated with rupee cost averaging. But remember, this does not mean SIPs eliminate risk. They don't. Mutual funds are market-linked investments. Your portfolio can fall, and sometimes it can fall significantly. The real advantage of SIP is that it reduces the pressure to decide, is today the perfect day to invest? Instead, you follow a process. And for many investors, a process is easier to follow than a prediction. But there's something investors must understand. More SIP money doesn't automatically mean every mutual fund is a good investment. This is extremely important. A mutual fund can have a strong past performance and still perform poorly in the future. A fund that is popular today may not always be the best choice. And investing blindly because everyone else is investing can be dangerous. You need to understand, what category is the fund? What is your investment horizon? How much risk can you handle? What are the costs? How diversified is the portfolio? And most importantly, does this investment match your financial goal? Don't choose a mutual fund simply because someone on YouTube, Instagram, or WhatsApp said, "This fund will double your money." There are no guaranteed shortcuts. So, what's the real reason SIP money keeps flowing into mutual funds? It's not just one reason. It's a combination of several powerful trends. More Indians are earning digitally. More people understand investing. Technology has made investing easier. Financial awareness is increasing. And investors are slowly shifting from, "Where can I save money?" to, "How can I build wealth?" That's a major mindset shift. And perhaps the biggest change is this. People are beginning to understand that wealth isn't necessarily created by one big investment. It can be created through thousands of small decisions repeated consistently over many years. 1,000 rupees, 5,000 rupees, 10,000 rupees. The amount matters, but so does the behavior. So the next time you hear that billions of rupees are flowing into mutual fund SIPs, remember, the story isn't simply about mutual funds. It's about a changing India. An India where more people are thinking about tomorrow, more people are investing systematically, and more people are discovering the power of long-term wealth creation. But don't invest because everyone else is doing it. Invest because you understand why you're investing. Choose your goals, understand your risk, stay disciplined, and give your investments something that no shortcut can replace: time. If you found this video useful, subscribe to Naveen Finance for simple, practical financial education. And remember, don't chase wealth overnight. Disclaimer: mutual fund investments are subject to market risks. Read all scheme-related documents carefully. This video is for educational purposes only and is not investment advice.